Hello, this is Jessica Dunn, and this is Economic Development Finance, Finance 610. We are going to start this class by talking about the role of economic development. Not everyone automatically understands what economic development is. It is any activity that can improve the quality of someone's life, or could create a safe environment, or could create jobs or provide infrastructure. It doesn't just result in profits or cash flows. It's something that can do good for a community. So let's rewind a little bit and talk about just plain finance. Typically in my finance classes, we are talking about how to make money, how a company is organized. In this class, we're not going to be talking about that quite as much as we would in something like corporate finance. But finance is the science and the art of managing money. Economic development finance, too, is both a science and an art. It doesn't necessarily fit into nice little neat boxes like a bank would like, so it is perhaps a bit more art than typical things that you would talk about in the field of finance. At the personal level, finance is concerned with an individual's decisions, like how much of their savings are they spending and how much are they saving. In a business context, we're talking about similar types of decisions. We're talking about how do they get their money, how do they invest their money, how do they decide where to reinvest profits. It would even answer questions like who owns the company, who controls the company, who holds the risk, and who makes the profits. So economic development is the process of creating or using assets to generate or improve economic well-being and quality of life in a community. So it's the process of creating and using assets. These assets can be physical assets, human assets, financial assets, or even social assets. The outcome of economic development transcends jobs, income, and wealth. It even includes the quality of someone's life. So the goal of economic development could be to create a safe and healthy environment, to provide access to leisure activities, or even community celebrations. And it must be sustainable. Economic development is a team effort. It involves the active participation of entrepreneurs, business community, local, state, and federal governments. And it is important because to many borrowers, access to capital is more important than the cost of capital. Because there are a whole lot of people in this world who cannot get financing. Even if they have a good idea, there is no availability of funds. Perhaps their idea doesn't fit into a nice little box for the bank, or perhaps they are being discriminated against. But these individuals don't have the access to funds. And so here we'll talk about a little bit of a case study here. Paducah, Kentucky. We're all familiar with Paducah. Paducah had a problem. There was a huge supply of foreclosed and condemned housing in their downtown area. That's a problem with a lot of cities. But they did have a unique solution. Their solution was the Artist Relocation Program. It offered incentives to artists to relocate to Lower Town, and it relaxed zoning. So instead of downtown being a business-only area, they relaxed the zoning, and so now they allow for live and work spaces. So these artists are now allowed to conduct business and live in the same space. So the way it works, Paducah sold these abandoned properties cheap, very cheap, sometimes as low as $1. Part of the kicker was that whenever you did purchase the home, you had to agree to bring it up to code. Paducah Bank worked with the city of Paducah, and they offered low interest rate loans to cover the refurbishing. So an artist could go in, buy a home for $1, get a low interest rate loan from Paducah Bank to cover the cost of remodeling and fixing these historic abandoned properties. Houses did have to be brought to code. The problem was for the bank is that in a lot of instances, the banks were offering loans greater than the appraisal value. So when the appraiser went out to assess the property, there was no other comparable sales. The other homes had not been refurbished. There is no history of sales. And so they were having to go out on a limb here and assume that once these properties were refurbished, that they would be worth X amount of dollars. So an individual would come in, purchase a home for $1, but then they would need, $200,000 to bring these houses up to code. Not only livable code, but historic code. They had to use, proper architectural techniques. And so Paducah Bank really, really had to go out on a limb to do this. They couldn't necessarily find appraisers that shared their vision. And so they were loaning more money than these homes were technically worth to fix them up, in the belief that they would be worth that in the future. They also offered benefits to businesses. For example, they would offer $2,500 for someone to move or start a business. They would go all the way up to $25,000 for someone to open a restaurant. The result of this was nearly $40 million in local economic activity. So the role of finance in economic development. Economic development, as we've talked about, is something that is good for a class of people, a community. It doesn't necessarily result in cash flows generated. However, to make these problems fixed, to solve the solution, or to solve the problem, create a solution, and to make these communities better, cash does have to be involved. So there is a role of finance in economic development. So businesses require a market for goods and services. They require access to transportation, access to technology, access to labor. They require managers and entrepreneurs, materials and energy. They require facilities, equipment, and financial capital. So finance is a required input to generate jobs, income, and quality of life. Businesses require funding. Finance helps to generate desired outcomes of jobs, income, and quality of life, and it can be a constraint to business formation and growth. So if capital is not available, a business can't grow. When capital is not available, economic activity slows. But regions also have to provide financing for the other necessary inputs to support business activity. So they can't just make business loans. They also have to provide financing for infrastructure. So if you're going to operate a business, you have to have roads to get to your business, phone, electric, water, airports, railroads, educational training, etc. All of these are required for a business to operate, in addition to the capital that they need to create their business. So economic development finance focuses on the direct financing of firms, but also on those items necessary to make successful firms: infrastructure, land and real estate facilities, education and training. The role of economic development finance is to fill the gaps. Capital market gaps sometimes exist. So in a competitive market, funds are allocated to their most productive uses. But when market imperfections arise, capital may not be allocated to its most productive use, and a capital market gap would arise. When these market imperfections arise, the gap will be systematic and will affect an entire class of financial transactions, firms, or projects. So the role of economic development finance is to supply capital to firms and projects that can productively use it. So when things are working perfectly, the most productive use would receive financing. But because of market imperfections, capital is not always allocated to its most productive use. Sometimes this is intentional, and sometimes it's accidental. So it could be redlining or discrimination, or it could just be lack of access to capital. When these gaps are filled, new economic activity results. There are public sector solutions and private sector solutions to these capital market gaps. Public sector solutions are meant to provide capital to entities that are creditworthy but are not considered good risk in traditional commercial terms. Public sector solutions invest where the economic and social benefits exceed the risk of investing. So it could be something like neighborhood development or job creation. So where the public benefit exceeds the risks. So why do capital market imperfections exist? What causes these capital market gaps? So in an efficient market, we have many assumptions. When one of these assumptions are violated, we often receive capital market gaps. So in an efficient market, we assume that there are many suppliers and users of capital. However, that's not always true. In rural areas, there is often a lack of competition. There are fewer banks. There's less competition for loans. So that usually results in a bank being able to play it on the safe side and only fund the best and most safest ventures. So because there are plenty of opportunities for a bank to lend and they don't have many competitors, they get to cherry pick exactly which investments they want to make, and they don't have to go out on a limb. They don't have to take any extra risks. And so oftentimes good ideas that are risky are not funded. Regulations do try to prevent this, so all banks are overseen by regulators, and they do try to prevent this with their Community Reinvestment Act guidelines, CRA guidelines. The CRA guidelines simply state that a bank must meet the credit needs of the entire community. So they can't eliminate specific classes. They have to make loans to each of the different groups within their community. So they would look at a service area of a bank, and they would see what portion of individuals within that service area are lower income, what portion are higher income, what portion are African American, what portion are Asian, what portion are Caucasian. And then they would look at their loan portfolio and make sure that portions of their loan portfolio are occupied by a representative amount of these different classes of people. So making sure that lower income individuals are receiving their proportionate share of loans. Making sure that Asians are receiving their proportionate share of loans. Another assumption of efficient markets is that suppliers and users have perfect information about a transaction. So that's not always true. We often have imperfect information. So let's assume that you have a great new idea for an invention. Maybe you're like a molecular biologist and there's only 10 people in the whole country that understand what you're doing. It's going to be very, very difficult for you to convince a bank to loan you money for something that they will never understand. It's difficult for you to transfer your knowledge of something so precise and the importance of that knowledge to another individual. So your idea may be difficult to accumulate information on. Maybe difficult for you uh, to discuss it in terms that someone not in your field would understand. So maybe it's a new business or product or new software or new medicine, things that might be difficult to comprehend. Another assumption is that the cost to complete the transaction are insignificant. And that's not always true. Sometimes the cost to complete a transaction are pretty high. At a bank, whenever you go in and fill out a loan application, it takes that loan officer about the same amount of time to complete a large transaction as it does for a small transaction. So they're still having to go through and dot their I's and cross their T's and fill out the same paperwork, whether you're getting a $10,000 car loan or you're getting a $1 million business loan. They still need much of the same information. And so the time to completion for a small loan is often much higher in percentage terms than a large loan. So therefore, the cost of time and energy to analyze is higher for a smaller project versus a larger project. Another assumption of efficient markets is that all costs and benefits of the transaction are related in prices. And that's not always true. All costs and benefits are not reflected in prices. So sometimes social returns are greater than financial. So for example, an automobile company may produce a low emission engine. All of their return is not financial. There is going to be better air quality. That is not a financial return. That is a return that everyone gets to enjoy because of reduced emissions. Another assumption is that participants are rational benefit maximizers. Capital may not be available to very high-risk projects, even if their return is high enough to compensate for their level of risk. So something may be very risky, but if it's going to pay off, then it's going to pay out a whole lot. A bank may be scared off due to the risk, even though the return is great enough to counter-affect that risk. Or it could be simple discrimination, race, religion, or sex. So what happens if we fill these gaps? Number one, improved economic efficiency. Underserved populations will receive the financing that they need. And number two, social benefits. Capital to projects that yield desirable outcomes that private markets do not adequately value. So the low emission engines. It may cost a whole lot of money to develop these, and it may not have a huge financial return. But it provides a benefit to everyone. So private markets would not adequately value this benefit to everyone. So let's rewind a little bit, and we'll talk about the different types of capital markets. First, a private capital market. Well, just in general, a capital market is a collective set of institutions through which the savings of suppliers are transferred to the demanders of funds. And there are two types of capital markets. First is the private capital market. Private capital markets, these are commercial banks, thrifts, insurance companies, venture capitalists, commercial finance companies, and public capital markets, investment banks, securities dealers, and securities brokers. Public capital markets are regulated markets. They have extensive publicly available information. These investments are easily bought and sold. Individuals can directly purchase the financial assets sold in these markets, so stock markets, bond markets, money markets. And the institutions that handle these transactions are the investment banks, the securities dealers, and the securities brokers. So in a public capital market, problems often arise because it costs a lot of money to be a publicly traded company. At a minimum, it costs several $100,000 to sell stock or debt in a public market. To hire an investment bank, it costs several hundreds of thousands of dollars. A $10 million IPO costs roughly $1 million to complete. Investment banks are also selective. They're very selective about which securities they bring to the market. They prefer large offerings that generate large fees that can be easily sold. These high costs make it infeasible for most firms that need less than several million in capital. Also, investment fads, maybe internet stock. These can generate excess capital for specific, very popular, in-demand industries. Private capital markets are an alternative source of capital to firms that cannot access capital markets. Sorry about that. An intermediary organization holds and manages funds for investors. The suppliers of capital deposit their funds, who then determine where to place them. So the financial institution would conduct an investigation of the firm and determine their risk level and what interest rate the money must be repaid, and then use depositors' money to make a loan. So a commercial bank, these are government-chartered financial institutions that have access to deposit insurance. Thrifts, they have more limited lending powers than commercial banks. They do have access to depository insurance. Most thrifts focus on home mortgage and real estate lending. Commercial finance companies, these are not government chartered. They do not raise money through deposits, so they have more flexibility in the types of loans offered. So an example would be the Money Store or AT&T Small Business Lending. So the Money Store offers loans for franchises which some banks can't finance. Some loans that they make are smaller. They often make asset-based loans to small business owners who can't get money from banks. Insurance companies invest premiums. This is an important source of long-term financing for firms and real estate projects. Venture capital funds, these are private investment entities. They usually invest if they suspect very high returns. So why do problems arise? Number one, regional problems. Rural areas have fewer banks, so there's limited competition that reduces the availability of debt, because banks without competition earn above average profits on lower risk lending. Loan restrictions may add reporting costs. This places a limit on the firm's actions or sets financial standards that restrain activity. Information costs. Information is not publicly available. It costs as much to gather the information for a small loan as it does a large. Banks often refuse commercial loans under $50,000, and venture capitalists often refuse investments under $5 million. Government regulations. Regulations create financial incentives to hold less risky assets. Regulators can insist that banks cease and desist certain types of loans. So, for example, in June of '98, the Federal Reserve sent a letter warning to tighten lending practices because a recession could leave them with bad loans. CRA does help fix some of these problems. Another would be fads. So venture capitalists, they cash out with IPOs, and so they care a whole lot about what people think is interesting. So they do follow fads. IPOs do. A lot of times, if something is a popular industry or a popular idea, it earns a greater return or garners more interest than a less popular idea. And biases. Some lenders practice statistical discrimination. They may classify an entire group of businesses as too risky. They may even do so without evaluating the merits and risk of specific transactions. The Community Reinvestment Act is there to help eliminate this discrimination. So the firm's location, their industry, the amount of capital, the form of capital, the number of financial institutions in the area, all of these come together to affect access to capital. So how do we expand capital availability? We can perfect the operation of existing capital markets. So, number one, risk-sharing tools and policies. This encourages private sector institutions to bear greater risk and extend higher risk debt financing. An example would be a loan guarantee. So a community could offer a business a loan guarantee. This loan guarantee would ensure that a minimum percentage of the loan would be repaid even if the business were to fail. So this would help a community because the community is bearing some of the risk with the financial institution. So it makes the financial institution much more willing to invest with someone at a lower interest rate. A second would be bank regulatory policies. Bank regulatory policies can reduce barriers to economic development. They can create incentives to expand services and lending and investment for economic development purposes. And this would go along with your CRA. A third would be absorbing information and other transaction costs. So a community could help a bank with collecting and generating information, preparing financial applications, analyzing potential investments, or servicing loans. If these methods cannot be employed, it may be necessary to establish alternative financial institutions to ensure capital availability. An example of this would be a revolving loan fund. They provide loans to those who can't get them from a bank. The loans are made to multiple firms, and as they repay, the loan fund would be replenished and new loans would be made. An example of this, even on a small scale, would be Western Michigan University. They have a sustainability fee that students pay. So then they take proposals from students for new ideas within the university, either as income generating or cost reducing mechanisms. So for example, when you enroll at Western Michigan University, they give you an eco mug, just a cup. But the only acceptable reusable drink containers in dining services is the eco mug. So if you take your eco mug there, you can get refills all you want. If you forget your cup, you only get one drink. Another example of something they did, they had a USB stick. So whenever you enroll in a university, they often give you piles and piles of paperwork to do. Instead, they gave you a USB stick when you arrived. All your paperwork's on there, so it would save trees and money. Another example would be venture capital. Venture capitalists, they can provide funds for profit reasons or for doing good for the world reasons, I guess is the way to say it. It doesn't necessarily have to be profit. So a rich individual or a rich group of individuals would come together and offer loans to businesses. Number one, to create a profit, or number two, to create benefit for a community. Two community-based financial institutions. These are institutions that generally serve low-income populations. And then micro-enterprise funds. This is a fast-growing form of U.S. development finance. It focuses on small enterprises and the self-employed. So here's an example of an intervention. A region may create a loan guarantee program to expand bank lending. At the same time, they may create a revolving loan fund or micro-enterprise to supply debt in small amounts. So these are not restrictive. You can't use one and choose the other. You can employ multiple opportunities at one time. So typical financing goals. One, lower cost of borrowing. The public sector would subsidize the difference between the marked and the discounted rate. So this would reduce the interest rate that the borrower must pay. How do they do this? Number one, they could have direct financing. So something like a revolving loan fund, you could offer a low interest rate loan. A second would be industrial development bonds, or even they could get low interest rate loans from governmental programs. Second, lower risk. The public sector could guarantee a percentage of a private sector loan against default, so a loan guarantee. Third, different investment programs. Lending programs that address special needs of underserved groups. An example would be a startup loan, a small working capital loan, a micro loan. Community development corporations locate financing sources. They provide technical assistance and training. Loan packaging. Economic development practitioners helps entities to obtain financing by acting as a conduit. They could facilitate and coordinate the loan process. This would help alleviate the information costs for the bank. 5. Direct lending or investing. Federal or state grants, private sector investments, such as pension funds, technical assistance. So the Economic Development Office could provide help. They could help businesses prepare financial statements and loan applications. And then economically targeted investments. They could direct funds to opportunities that earn competitive returns while producing economic development benefits. So why do businesses need financing? Number one, working capital. They're most liquid assets, so they want to extend credit to their customers. Then they will need working capital to cover their operations before their customers pay their bills. So if you're wanting to set up where your customers are able to pay over time or to pay later, then you need cash on hand to cover your electric bill until you obtain those receipts. Or a company needs to ramp up production, so they know that in the winter, at Christmas, they're going to sell a whole bunch. That means that in July, they need to start ramping up production, which costs a whole lot of money, and they're not going to receive any of the benefits until Christmas. Or cyclical demand changes. Typically, for working capital, they use a short-term bank loan, a line of credit, or trade credit. Another reason why a company would need financing is for their fixed assets. Fixed assets are costly, and they do not generate immediate revenue to support their costs. They're typically financed with a long-term bank loan. And another reason for financing is simply just new business. New businesses typically use equity. Trade credit is not always available to startups. Trade credit is where your suppliers give you credit. So, for example, if you are a restaurant and you're working with Wonder Bread, Wonder Bread will drop off bread today. You don't have to pay till next week. So just FYI. And so what are the challenges for a new business? First, distressed communities. Distressed communities typically have high crime and low income. New firms in weak markets have difficulty obtaining capital even if they are expected to generate good returns. Additionally, these distressed communities have fewer banks. Second, minority firms. Minority-owned firms have difficulty securing financing because of redlining by traditional banks. These minorities often also have poor awareness of available lending programs and insufficient assets. And third, high technology. Capital for new and unproven technology is difficult to attain because it is risky. That's it for Chapter 1. Thank you.